Welcome into episode number 2 of Cloud's Retirement Talk. I am John J. Gay. I'm joined by Tommy Cloud from Third Act Retirement. We help build better retirements on this show. Great to be back with you, Tommy.
Thank you. It's so great to be back as well on the show.
So in our first episode, we spoke a lot about the different types of advisors, fee-based, fee-only, et cetera, et cetera. Today we're going to really break down the types of fees and how advisors are paid. And I think this is so important for our listeners to know as we think about finding a financial advisor and how your money is going to be spent and how you're going to spend your money on the advisor.
Well, that's exactly right. We all know the advisors are going to get compensated. You know, we're not out there being able to play golf every single day for nothing, right?
Exactly, yeah.
I'm just kidding. I play about 1 or 2 tournaments a year, but had to get that joke in there. So many people, I think, have misconceptions about what we do, but that's all right. That's all right. You know, we want to talk about, first I want to talk about the commission. I think is one thing that you want to be clear about. So when you begin to work with someone that works on a commission basis primarily, they're not fee-based, they're not fee-only. Let's say you give them, let's say $500,000. And so they decide they're going to put $270,000 of it in an account at their broker dealer is what it would be called.
Sure.
Not custodian. When you're dealing with fee-only and fee-based financial advisors, it'll be called custodian. Although even with fee-based, it's oftentimes called broker dealer. But they'll put it at their broker dealer. And let's say they take that $270,000 and they'll invest it in mutual funds. And the mutual funds will have what's called a front-end commission typically. If it's a share, okay? So if it's an A share, what'll happen is on the mutual fund, you'll put it in and they'll get paid anywhere from 2 to 5% commission on that, in this particular example, $270,000.
Okay.
If it's a B share, what'll happen is they'll put the money in and the financial advisor will get an ongoing fee, but the big fee doesn't come until you try to take the money out of those mutual funds. And that's where you'll see the larger percentage commission, which will vary depending on the mutual fund family and the particular mutual fund. And then finally, you have what's called the C shares. Now, the C shares for financial advisors that they use, it doesn't have an upfront commission typically. It doesn't have a backload commission typically like the B shares. What it does have, though, is an ongoing fee that's higher than either the A or the B shares. So they might make anywhere from 1 to 2% ongoing for the money that was put in for this $270,000, and they'll get paid that fee every month or every quarter, depending on the agreement that they have with their broker dealer.
Okay, got it.
So that's one thing that could happen with the money. The other thing that could happen is we've now still got $230,000 left. Maybe we'll take $100,000 of it and we're going to put that into an annuity. The lowest commission annuities are the single premium deferred annuities, and those commissions are going to be anywhere from 1 to 2%. One time, and it just is going to offer you a rate much like a CD. You'll buy it a 3-year, 5-year, 7-year, 10-year, and it's going to pay you 1% a year, 1.5% a year, whatever it may be in today's interest rate terms. Now, when I entered the industry, it was much, much higher than that. When I entered the industry 20 years ago, money markets were paying 5.5%. Of course, in 1981, they were paying 18%. So bonds have just skyrocketed since I've entered this industry. That's a whole nother discussion.
Yeah.
But the single premium deferred annuities are by far going to be the lowest commission annuities that you can buy from an insurance agent or financial advisor.
Okay, got it.
Then we move to variable annuities, which are going to be higher. They're going to be 3%, 4%, 5%. You put your money in. Let's say you put in $100,000 in this particular example to take us to a full investment of $370,000. And what happens is, of that $100,000, only $95,000 is going to go to work for you. The other $5,000 will be paid out in commission.
Okay.
Now, the financial advisor, depending on the agreement they have with their broker dealer, will not get all that commission. They might get 50%. They might get 90%. It all depends on their agreement with their broker dealer and what kind of producer they are. The more they produce, the higher their payout is.
Got it.
So finally, we have the good old equity index annuities that Clark Howard cannot stand. And these annuities are structured in different ways. Their commissions can be cranked all the way down to 5%, where the agent will get paid 1% a year. It's typically a minimum of a 5-year commitment, but oftentimes they go to like a 13-year commitment on these equity indexed annuities or fixed indexed annuities. They are fixed annuities. They are guaranteed. They're not like the variable annuities that I just mentioned. And these particular annuities will sometimes pay the agents as high as 7%. They're the highest commission products. But if that happens, the agent won't get paid along the way. So they'll typically maybe do 5% up front and then 1% for the life of the policy. Let's say it's 9 years. And so now we've invested $370,000 in this particular example. You've seen how they've gotten paid with the mutual funds at their broker dealer. You've seen how the broker will get paid, or the financial advisor will get paid from the insurance company from the sale of annuities, with the single premium deferred annuities being the lowest commission annuities,
Right.
and the fixed indexed annuities being the highest commission annuities. And in the middle is the variable annuities, which are also high. So now we've got this $130,000 left, and let's say we're going to put $100,000 of it into a life insurance policy. And we're now going to go and buy let's say a universal life policy. It could be a variable universal life. It's the same thing. You put the money in, and the agent's going to get a big first year commission. It varies from company to company. And there's all different types of insurance companies out there. Some are better than others. One of the things that we do for our clients is review their insurance policies and make sure that they're in a solid insurance policy. And we don't charge that. It's part of the fee that we charge overall for our clients. I mean, we do charge a fee, but we don't charge for that specific activity that we do for our wealth management clients.
Got it. Okay.
So now you're going to put $100,000 into a variable universal life, a variable life. Now, these are policies that don't have the guarantees because they are linked to the performance of the stock market typically.
Okay.
They have commissions up front. Same with the universal life. If they're fixed and guaranteed, they're not linked to the stock market, but you're still going to pay an upfront commission. Now we've got $30,000 left, and we're going to take that and put it into a long-term care policy.
So it's so important given the cost and the rising cost of long-term care.
It really is important for every person to look at their specific situation and determine if it's going to be wise for them to purchase it or not. When you have someone that takes this final $30,000, that's going to be another commission that the agent will get paid.
Okay.
So as we look at this $500,000 and we average it out, it's going to be a tremendous amount of commission that's going to be produced by the life insurance and the long-term care the first year.
Got it.
This is going to be a big situation. And then the commissions on the life insurance and long-term care will go down. Now, the life insurance will go down more than the long-term care if it's an ongoing payment. But that might kind of look like what a situation would look like with a commission-based financial advisor. Do you have any questions for me, John, about the commission-based situation?
No, I mean, it seems pretty straightforward. You're talking annuities, you're talking all different types of annuities, and really the only difference is at what point in the process that advisor gets paid their commission, right?
That's exactly right. That's right. And so then we move to fee-based. Everything stands with the fee-based, except now maybe we're going to take this $270,000 and put it at the broker-dealer or the custodian.
Okay.
Okay. And at this situation, at the broker-dealer or the custodian, they're going to just be charging a fee from 1% to 2%. It's just that simple.
Got it.
Typically with fee-based, they can also maybe charge you for a financial plan. It's not real typical. And then anything else they sell you, annuities, mutual funds, if they're not doing they're charging you a fee on what they're managing for you, they could still get commissions on the mutual funds. It's important to ask these questions. One of the things that we do is we go over with our clients, we have a disclosure of financial planner compensation. That's on the website. And you can go in there, literally our sheet, you list the investment and insurance products, and we have a slot where you can write down the estimated commission rate and the estimated income to the planning firm and all of its affiliates, which is also indirect compensation. That's another thing I want to talk about very briefly. I've been working with Charles Schwab starting in March of 2000. I opened up my first account with them in July of 2000. And they, have never given me anything. They don't even send me birthday cards. And I want to make that very clear. When you're working with insurance companies, some of these guys are flying to Aruba. They're going to Australia. They're going to Hawaii. These are regular trips. before I started as a fee only in the late 90s, I was working for a company. I remember we were flown out to Hawaii for these products that we were selling. And so we were getting commission on the products, plus you get rewarded. And so that's another indirect compensation for the advisor. And it's not just trips to Hawaii or Costa Rica or, Mexico, or cruises are very common, extremely common. However, they also can send them gift certificates of $250, $1,000 or more. And so it's not just the commission. There's also the indirect compensation, the rewards and the trips that the commission-based financial advisors and insurance agents are still getting to this day.
This goes back to something we talked about in our first episode, Tommy, and that is if you have an advisor who's recommending you certain annuities, certain investments, whatever it is, if they're getting all this stuff for getting you into these plans, it really has to make you question what their motivation is.
Well, it's just, again, it's really difficult it's a great question. It's a fair question. And as I look at my own heart and I examine myself, it puts you in a tough situation where you can sell for this one company. And if I can just sell $700,000 more with them, I can go with my little sweetheart over to Hawaii. And we get to stay in a hut down there on the beach, which we did, which we absolutely did. This was in the late 90s when I was in my 20s. We stayed on a hut on the ocean at one of the top resorts on Maui.
I love Hawaii. We went there on our honeymoon. We went there for my wife's 40th. That could be a whole other podcast episode, is Hawaii.
It's so beautiful. It's so great. And the investors it wasn't that we were doing anything bad to the investors, but it was a matter of situation where, and I owned 0% of the company and I was an employee and so forth and so on. However, it's very tempting. It's very tempting to put yourself in that situation. If you struggle with being an alcoholic, you probably don't want to go in a liquor store.
Sure.
And even if you don't struggle with certain things, you still wouldn't want to put yourself in those situations.
Right.
You don't, Billy Graham, when he used to travel the country speaking, he would go into the hotel rooms and rip the TV out. Not because he struggled with issues of watching inappropriate TV content, I don't believe. However, he didn't want that temptation there.
Got it.
And that is what we're trying to talk about when we talk about compensation. You don't even want that opportunity available to you because you don't know what day, what month, what year you're going to be in a situation where you're making decisions and making recommendations that aren't in the best interest of the client.
Understood. It makes total sense.
So here we are, fee-based, and you still want to look at, when you're dealing with investments, you want to look at the 12B1 fees. You want to ask about surrender charges, not just with mutual funds, but especially annuities. Back-end fees, again, with the annuities, they may not be commissions that go to the agent, but they have these penalties to cancel early on the annuities. They have the commissions on the backside of B-share mutual funds that we talked about. There's contingency fees. There's wrap fees. There's what we just talked about, eligible for sales prizes. You want to ask the financial advisor about that.
Yeah.
How are they compensated for sales prizes? What trips can they win? What cars can they win? Soft dollar benefits. We talked a little bit about that. Performance compensation. The more they sell, the more their commission goes up. And then, of course, we talked about trailing commissions. And all of these are important things that you've got to understand when you're getting ready to hire any financial advisor. And again, we have the form, the compensation disclosure form, that we can provide anybody at no charge and that they can use when they're interviewing financial planners to hire them.
On that point, I'll mention, if you're listening to this as a podcast, you will have in the show notes a link to Tommy's blog article covering all of this. And in that blog article, we're also going to link to the form that Tommy's talking about. Whether you work with Tommy at Third Act Retirement or you're working anywhere else for that matter, this is a good worksheet to have when you're interviewing an advisor to really get a good 360-degree understanding of how that advisor is compensated and how that relates to you and your money.
That's exactly right. And so then we move to the final model, which is less conflict of interest, and the fiduciary model, the fee-only model.
Right.
And in this particular model, what's going to happen is there's many ways to compensate. You can pay the advisor by the hour. That's typically going to be, depending on their experience, probably $200 to $400 an hour, depending. Then you can just pay a fixed fee for a financial plan. That'll be thousands of dollars depending on the advisor. Maybe it's $1,000, maybe it's $5,000, and they're going to charge you for their financial plan. And these are all what the industry standards are now as we're doing this show here in 2020. And then you have, of course, the assets under management, which is our preferred model, where they're managing money for you and they're charging a percent on that. And then you have all the services included with that. You also have fee calculators that one of my mentors is actually using, where it puts in your net worth, it puts in your income, it puts in the services that you'll be receiving, and it calculates a fee in this fee calculator, which is another way to do things, or just a percentage of income. So, commonly a percentage of income is 2 to 2.5%. And then commonly if you're being charged assets under management, it's going to be 1 to 2%, depending on, how much you have. The more you have, the lower the fee is going to be. And as you get into the millions that a financial planner is managing for you, it can even go a little below 1%.
Right. If you're managing that much more money, sometimes that fee will go down. You have the negotiating power to do that if you have that much money under management.
That's right.
So the three types of advisors we've talked about: fee-based, fee-only, and commission-based. Really, it affects how you're charged as a client. It affects a lot of different things. And it's so important to know the differences in what you're dealing with when you're going to interview a financial advisor. And we come back to that fiduciary standard, Tommy, which is that you have to act in your client's best interest, right?
Well, that's exactly right. That's what when you and I talked about this show, we're here to provide information to people through this show that'll be helpful to them, regardless of if I ever hear from them. A lot of people don't meet our minimums, which is great to be able to do a show like this and help and educate more people. So as we're looking at the fiduciary standard, here's the thing. And this, and I think people know this, the fiduciary standard is real. The fiduciary standard becomes extremely useful in court cases. And much like with doctors now, their malpractice insurance is just remarkably high.
Sure.
And so same with me. The insurance in my industry for not malpractice insurance, but for that types of, it's called errors and omissions insurance, is very, very, very expensive, particularly because the fiduciary standard is one that is so high. And it's something that it will help protect you, God forbid, in lawsuits. And I haven't had a complaint in 20 years of business, not even a complaint. And I've never had a lawsuit in 20 years of business. So however, the bottom line is, though, regardless of whether you're fiduciary or not fiduciary, it all boils down to the planner's character.
Yeah.
Every single person I know, and you mentioned in the last show about the dating world. Unfortunately, I've been in the dating world for about 5 years, and I've never been in an environment where people struggle so much with the truth. I've been dealing with money and around money and talking about money for my whole life, especially the last 20 something years. And I've never seen the dishonesty that I've seen in the dating world. And everybody believes in their hearts, they truly believe that they have great character. But let me tell you this, one thing that I've determined and found out from being in the dating world, and I believe it to be true in my industry, is that everyone's standard for truth is different.
I like that. Yeah.
People will be willing to say things and do things. And I will never forget, I had a friend, he's still a friend. He's just never going to be a close friend, but he had told some lies. And I confronted him on it. And he said, yes, those were lies. However, I would tell those lies again with Jesus sitting next to me, and Jesus would laugh. And I would put my hand on a Bible and tell those lies all over again. And that response was so telling to me and so interesting to me. I'm not perfect. I have so many things that I struggle with and so many things that are difficult for me to do the right thing in that particular areas. But the fiduciary standard, what it does, John, I would say, is it makes advisors think twice about everything they're doing, knowing with this standard hanging over our heads, we're probably going to take a butt kicking if it goes to court.
Sure.
If we don't have the document to back up what we're doing, the software to back up what we're doing, the conversations, every recommendation that we're making, particularly the older the client gets and you get into widows. And I've been working with widows for 20 something years. And so now all of a sudden, if you go before a judge, the SEC, and you're my age, you're a planner, and you've got a 70-something-year-old single woman, they are going to come after you with a fine-tooth comb, and the attorney is going to hammer every single moment that he can.
Yep.
Fiduciary standard, fiduciary standard, fiduciary standard, and over and over and over again, that the other guys don't have to live to. But I still say this, at the end of the day, regardless of the standard, regardless of what we've seen, because we've seen some very, very bad behaviors from teachers over the years, from lawyers over the years, from judges over the years, from priests over the years. And so it doesn't matter the standard. It only matters what the person's character is. And that's very difficult to judge because, once again, everybody truly believes and tells themselves that they're a good person.
That is a really good way to sum it up, Tommy. And if somebody wants to come talk to you at Third Act Retirement, phone number, email, website, what are the best ways for people to find you if they want to talk to you about their money going forward?
Thank you. Emails thomas@thirdactretirement.com. Our 800 number is 917-5016. Our local number is 770-971-2888. And our website is thirdactretirement.com. Thanks for asking, John.
Tommy, have a great holiday to you and your family. We'll talk to you again in January. And I know you're a Georgia Tech guy. I'm a Syracuse guy, so maybe we'll talk some ACC basketball come next year.
I would love that. Merry Christmas to you and your family as well, John.
Take care.